Welcome to the Deep Dive. We break down the key earnings calls and strategic shifts so you get the insights without wading through hours of audio. Today, we're tackling the Q3 2025 earnings call for a major player in transportation and logistics. Our goal: to understand the mixed signals, the market's caution, and frankly, management's pretty bold bet on LTL growth and a major capacity crunch coming down the pike in 2026.
Yeah, it was a really interesting call. If you follow freight, this one kind of captured the whole sector's mood right now, didn't it? You've got this immediate financial pressure, but underneath, there's this very optimistic view on the longer-term structure.
And the market reaction reflected that immediate pressure.
Absolutely. The stock took a hit because, the headline numbers were messy. That always spooks investors first.
Okay, let's start right there with those numbers, because they were definitely a mixed bag. Revenue actually beat expectations, came in at $1.927 billion against the $1.90 billion consensus.
Right. So decent number there, up 2.7% year over year. Looks like solid top-line growth on the surface.
But, and there's always a but, isn't there? The focus snapped right to the bottom line, the earnings per share.
And that's where the miss happened, yeah. Adjusted EPS landed at 32 cents. The street was looking for something closer to $30.37.
So, 5 cents short, you put it together, revenue beat, EPS miss, and then throw in a kind of cautious Q4 guide.
Yeah, that's a recipe for market skepticism right there. People start asking questions.
Okay, so the big question is, if revenue beat, where did that 5-cent EPS miss actually come from? Was it the core business suddenly getting less efficient? I mean, it's a tough freight market. We know that.
Well, that's the critical point management tried to make. They argued this wasn't really about core operational weakness driving that specific miss. It was almost entirely down to about 10 cents per share in costs that they called out as, let's say, unusual or discrete items. But importantly, these weren't adjusted out of their main non-GAAP number.
Okay, unpack those for us. What were these discrete costs? Sounds like maybe some cleanup work.
Exactly. Basically tackling some legacy issues. On half of it, so roughly 5 cents, was tied to an unexpected loss contingency. This was linked to exiting an old third-party carrier insurance business.
Okay, a legacy business exit. Makes sense. What was the other half?
The other 5 cents or so came from higher insurance and claims costs, specifically tied to the U.S. Xpress integration. They settled 2 pretty large auto liability claims that actually dated back to 2023, before the deal really closed and integration kicked off.
Right, the U.S. Xpress deal. I think anyone watching that knew some cleanup costs were inevitable, probably just a matter of when they'd hit the income statement.
Yeah, you could argue they should be mentally adjusted out, especially those old claims. But Wall Street generally doesn't like seeing big surprise one-offs, even in the adjusted figures. It raises eyebrows.
Did the analysts on the call seem convinced that this cleanup is genuinely done now, or was there still some skepticism?
I think the focus shifted pretty quickly. Management wanted to talk about the underlying health of the business segments, which they argue is actually quite strong. And, you can see that clearly in one particular area.
Let me guess. Less-than-truckload. LTL.
You got it. The LTL segment, that pivot is really the foundation they're building on. LTL held steady, accounting for 20% of their total revenue in the quarter.
And that 20% share, that's significant, right?
It's the highest share it's ever been since they entered the LTL market back in 2021. So, yeah, its importance just keeps growing quarter after quarter.
And the growth numbers themselves.
Pretty impressive. LTL revenue, if you strip out fuel costs, jumped 21.5% compared to last year. But what really stood out, I think, was the margin performance.
The operating ratio, the OR, that key efficiency metric.
Exactly. Their adjusted OR in LTL hit 90.6%.
90.6%. Okay, why is that number so important?
Because it was a big improvement sequentially from Q2, about 250 basis points better. And management made a point of saying this was counter to the usual seasonal trends.
Right. Q3 usually sees things slow down a bit, maybe margins compress slightly.
Typically, yeah. So improving that much against the seasonal headwinds was notable.
And what they say drove that improvement? Cost cutting.
They pointed to a couple of things. Specific cost initiatives, like using less purchase transportation, meaning using fewer third-party trucks and getting smarter with their pickup and delivery routes, using new tech. Plus, they're physically expanding the network. Door count was up over 10% year over year. So they're building out the footprint while also getting more efficient.
Okay, so LTL is the clear positive story. Now let's contrast that with the traditional truckload or TL side of the house, still feeling the pain of the weak market.
Oh, absolutely. The TL segment is where you really see the impact of the oversupplied freight market. Its adjusted OR was 96.2%.
96.2, so significantly worse than LTL.
Right, and that was actually 60 basis points worse than last year. And remember those U.S. Express legacy claims we talked about?
Yeah, the insurance settlements.
Those directly hit the TL segment's OR by about 110 basis points. So even without that, the underlying TL market pressure is evident. It shows how sensitive that division is to market capacity swings.
Which kind of perfectly sets up the big strategic story they were telling, right? It all comes back to capacity.
Exactly. Management's entire thesis for getting more profitable in 2026 really hinges on capacity rationalization. They aren't just waiting for demand to boom, they're betting on the supply side shrinking, partly due to regulation.
Okay, this is the fascinating part. What's the specific bet here?
Well, they acknowledge the market is still oversupplied right now, no denying that. But they believe capacity is going to start exiting the market much faster, particularly heading into 2026. And the driver they see is increased regulatory enforcement. Friction, as they called it.
Regulatory friction, like what specifically?
They highlighted two main areas: the increased focus on English language proficiency standards for drivers and actions by the FMCSA, that's the Federal Motor Carrier Safety Administration, targeting non-domiciled commercial driver's licenses, or CDLs.
Okay, why does that specific regulatory stuff matter so much to a big carrier like this?
This is really the core of their 2026 outlook. The idea is that this kind of enforcement will disproportionately hit the smaller, often lower-cost carriers. The ones that maybe operate on thinner margins or have less robust compliance departments.
The ones that often flood the spot market and keep rates down.
Precisely. And management expects this carrier attrition to be concentrated in the one-way, over-the-road truckload market. That's where this company does about 70% of its TL business.
So if those smaller players get squeezed out by regulation,
it could significantly shift the supply-demand balance, maybe quite quickly, benefiting the larger, more established carriers who remain. That's the bet.
Okay, so that's the external hope, the regulatory tailwind. What are they doing internally in the TL segment while they wait for that to potentially play out? Just cutting costs?
Pretty much. They're very focused on improving TL margins right now, irrespective of the broader market.
Yeah.
For Q4, they're actually targeting a sequential improvement in that TLOR of 250 to 350 basis points.
That's a pretty aggressive target for one quarter in a tough market. Where's that coming from?
Purely internal efforts, according to them. Things like tighter cost controls, productivity gains, getting more miles out of each tractor, optimizing the network, basically, controlling what they can control.
Makes sense. And turning back to the LTL side, there was also news about branding, right? Consolidating under one name.
Yeah, they're putting all their LTL operations under the AAA Cooper banner. That's a well-known historic name in the LTL space.
Is that just a marketing thing, or is there more to it?
They stress it's more than just a logo change. They said they're already operating as a single unified network behind the scenes. So this simplifies things for customers and, importantly, unlocks more internal efficiencies and synergies.
Synergies like between LTL and TL.
Exactly. Management talked about being in the, quote, early innings of leveraging those connections. For example, using empty TL backhauls to move LTL freight.
So instead of paying another company to move that LTL freight,
they can use their own TL trucks if they have capacity heading in the right direction anyway. Or using the TL fleet to handle surges in LTL demand instead of relying heavily on expensive purchase transportation. It keeps more revenue and potentially margin inside the company.
That integrated network effect. Okay, so the long-term strategy is clear. Grow LTL, hope regulation shrinks TL capacity, and find synergies. But let's get back to the immediate term. We still need to get through Q4. What did the guidance look like?
Well, as we mentioned, it was cautious. They're projecting adjusted EPS between $0.34 and $0.40 for the fourth quarter.
And what's underpinning that range? Any signs of market improvement yet?
Not really, based on their comments. They specifically flagged that LTL demand seemed a bit softer than the normal seasonal slowdown early in Q4. So that suggests the near-term market pressures are likely continuing.
So what are the key assumptions baked into that $0.34 to $0.40 EPS guide then?
Okay, a few things. They expect LTL revenue, ex-fuel, to still grow nicely year over year, maybe 10 to 15%.
Yeah.
But they guided the LTL operating ratio to be similar to last year's Q4.
So suggesting some of that Q3 margin strength might fade a bit seasonally, as expected.
Exactly. It implies some seasonal margin softness compared to the strong Q3 result. Also, crucially, that guidance range includes a couple of tailwinds.
Like what?
A significant gain on sale, somewhere between $18 million and $23 million, is expected in Q4. And they also anticipate a lower adjusted effective tax rate, around 23% to 24%. So those help support the EPS number.
Got it. And any changes to spending plans?
Cool.
Capital expenditures?
Yeah, they did trim their full year 2025 net cash CapEx guidance. They brought the range down. It was $525 to $575 million now. It's $475 to $525 million.
Pulling back the reins a bit seems prudent in this environment.
It definitely fits the narrative, right? Manage capital tightly through the current challenges, focus on LTL maturity and cost cuts, and position everything for that hoped-for inflection in 2026, driven by that regulatory capacity removal theme.
So, summarizing the whole call, near-term pain from those discrete costs and a soft Q4 outlook. But the strategic focus is laser-sharp on growing LTL and betting big on regulatory changes, cleaning up the TL market for a much better 2026.
That's the arc, yeah. Short-term headwinds, long-term strategic pivot.
Which brings us neatly to our final segment. How do you potentially trade this setup? How do you translate this narrative into an idea?
Okay, standard disclaimer time. We are analysts sharing insights. This is absolutely not financial advice. For informational and entertainment purposes only. Please do your own research.
This is not financial advice. All right, with that said, let's hear the outrageous but plausible trade idea based on this call.
Well, the trade idea here is built directly on that regulatory catalyst we spent time unpacking. The play is essentially to go long the stock.
Okay, long the stock. But not just because LTL is growing.
Not just that, no. The specific angle is to play it as a multi-quarter bet on accelerated, regulatory-driven attrition in the truckload market.
So you're betting that the regulatory crackdown actually works, and works faster than maybe the market expects.
That's the core thesis. The idea is that this sustained enforcement, the English proficiency, the non-domiciled CDL focus, is going to hit those smaller long-haul carriers particularly hard. The very carriers who often set the floor for spot market rates.
And the market isn't fully pricing this potential disruption in.
It seems like it might be undervaluing the immediate impact this could have on available capacity. I mean, management themselves noted on the call that they're already seeing some friction and capacity issues because of this in certain lanes within their logistics business. It's starting now.
So the bet is basically that capacity shrinks faster than anticipated in 2026, maybe even if the economy stays sluggish?
Exactly. If the FMCSA keeps the pressure on, you could see a pretty rapid tightening on the supply side. That could lead to a sharp turn upwards in spot rates, something that doesn't seem fully baked into the stock price right now. You're essentially betting regulatory action forces the turn.
Interesting. So the company gets through the trough, digests the U.S. Xpress costs, becomes this leaner LTL-focused carrier, and then finds itself perfectly positioned when that regulatory capacity vacuum really starts to bite in 2026. That's the scenario where the stock could potentially re-rate significantly.
Fascinating angle.
Yeah.
All right, that wraps up our deep dive on this Q3 2025 earnings call. A lot to unpack. The near-term cost noise, the soft guidance, but underneath it all, that very clear strategy around LTL and the bet on regulation reshaping the TL landscape.
Definitely. And as you watch this play out, the key variable to track really is that capacity enforcement. Management mentioned over 200,000 non-domiciled CDLs were issued recently.
Yeah.
The big question for you to think about is what percentage of those actually leave the market because of these regulatory actions, and how fast does it happen? That's what will likely dictate the timing and the intensity of the next freight upcycle.
A crucial question indeed, something for all of us to monitor. Until next time, keep digging into the data.